Hello everyone and welcome to my YouTube channel where I teach economics for class 12th, especially the CBSE pattern, and this is the second part of the video from the chapter Money and Banking. If you go and visit my channel, in the first video I already explained about the importance of money and the meaning of money as well as demand and supply of money. In this video we will be trying to understand what is banking and certain basic terms of the working of banking in India. So this is going to be part 2, the second video of the series in money and banking, and we are going to deal about specifically banking and how it works. So first of all, it's very important to understand the definition of banking. What is banking? Banking can be defined as accepting, for the purpose of lending or investments of deposits, money from the public, repayable on demand or otherwise, and withdrawable by check, draft, order or otherwise. When we look at this definition quickly, it is quite confusing, but then let me try to explain it in as simple terms as possible. So firstly, a bank accepts money from the public, and this is called as deposits. Whatever excess money we have and don't like to keep with ourselves as cash, that we deposit with the bank, and that is accepted by the banks. So this is the first function what a bank does. It accepts money from the public. Now what is the purpose? What does the bank do with these deposits? The bank lends this money in the form of loans, and it also invests this money in different kinds of businesses. And the interest on loans is the profit for the bank, and also the profit from investments becomes the profit for the bank. And so it uses our money, and it not only safeguards it, but also uses it for further purposes such as giving loans, various kinds of loans, and also investing in various kinds of businesses. Now this money that we have deposited in the bank can be repaid to us whenever we demand it. For example, if we own a savings bank account or a current account, whenever we want to convert or withdraw cash, it should be available to us on demand. But also banks have certain other kinds of accounts such as fixed deposits and recurring deposits, which are there for a longer period of time and can be only withdrawn by us when the time period is over. For example, if I have a recurring deposit for 10 years, this means I will be only allowed to withdraw the money once the 10-year maturity period is complete. So that is the meaning of repayable on demand or otherwise. And withdrawable by check, draft, order or otherwise. Now this is the last part of the definition, and this is basically showing us how are the different modes with which we can withdraw money from a bank. We can use a check, which is an instrument. We can use a draft or a demand draft. We can use an order, a money order, or now with the use or rise of digital payments and digital payment apps, we can even use digital payments to withdraw money and make payments. And so this is basically the function of banks. In simple terms, it accepts deposits, it invests those deposits or provides it as loans. This can be used on demand, this can be withdrawn on demand or for a longer period of time. And it can be withdrawn by various instruments such as checks, drafts, orders, or even digital payments, etc. So this is basically a simple but concise explanation of the meaning of banking. Now it is very important to understand the functions of a bank. And when I'm saying functions of a bank, I'm explaining the functions of a commercial bank. Now a commercial bank is an institution which provides banking services commercially, basically for profit. And it is not for the benefit of the people only. It only is using our money in order to earn profit, but then we also benefit from it. So what are the functions of a commercial bank? It accepts deposits of money from the public. It provides loans. It creates credit, which I'll be explaining later in the third video or fourth part of the video. It helps us to transfer funds from one place to another. It also helps in agency functions or acts like an agent. For example, bills of exchange, which we'll be studying in accountancy, securities or easy monthly installments are paid. We can give standing instruction. For example, the payment of an electricity bill. If we inform our bank that on a particular date, every single month we have to pay our electricity bill from the money available in our account, the bank will act like an agent, and on our behalf on that exact date, it will do all the payments of our bills. Or for example, we have taken a vehicle and we have to pay easy monthly installments or EMIs. We give a standing instruction to the bank, and on behalf of us, the bank will act like an agent and function by paying the necessary EMI on that particular date. So this is how agency functions work in a bank. And on the other hand, it also has other functions, for example, letter of credit, which we'll be studying in business studies class 11th, where it is basically helping importers and exporters to state their creditworthiness, helping in foreign exchange whenever we have to go to international travel or other countries, we have to convert our currency into various foreign currency. Investment advice, for example, the banks also advise us how to use our money for mutual funds or investments or insurance policies. Locker facilities, for example, if we have our gold or jewelry, we can use the locker facility in banks. Underwriting, where it acts as a guarantor for loans, and so on. So these are the functions of a commercial bank. Moving further, how does banking work? This is very, very important to understand. So in this particular section, I'll be dealing with various kinds of ratios to understand why do we use banks and how do banks use money, or how do banks actually work. So the first ratio to understand how a bank works is currency deposit ratio. Now, when we take the entire economy into consideration, this is basically depending on the behavior of a person. Some people prefer cash, while other people wish to hold money in banks. And this also changes from time to time. For example, during festivals, we wish to have cash in hand ready for spending on various things, whereas we save our money in the bank for future uses such as educational expenses, etc. So it depends from person to person. How do we want our money? Do we want it in cash or do we want it in our banks? And this ratio is called as currency deposit ratio. The ratio with which we want to keep money as cash and we want to keep money in our banks is called as currency deposit ratio. And mathematically, it can be expressed as currency is to deposits. I've given an example. Imagine I have 10 lakh rupees with me and I wish to keep 9 lakh rupees in the bank and 1 lakh rupees as cash. So the currency deposit ratio is 1:9, where out of 10 parts, 1 part is with me in the form of cash, and the remaining 9 parts are in the form of my bank deposits. So this is called as currency deposit ratio. Now, we will move into the second one, which is called as reserve deposit ratio. And in this, we are only going to deal that part which is deposited in the bank. So in the previous ratio, I told cash versus bank. And now in that, we are going to deal what is within the bank. Now, when consumers deposit their money in the bank has basically 3 options. What does it do? The first option is put that money in the vault of the bank, in the locker of the bank. The second option is it has to give or keep a certain part with the reserve bank or the central bank. And the third one is it can give it as loans to the people or invest it in various kinds of business. So this is basically the 3 options which a bank has whenever they get a deposit from you and me. Now, reserve deposit ratio or RDR shows the part of money which is kept as reserves in the vaults and the amount of money which is given away as loan. It is known also as legal reserve ratio or LRR. So mathematically it is shown as bank reserve is to loans. So in simple terms, reserve deposit ratio is basically showing us how much money is kept as reserve and how much money is kept as loan. The banks are not allowed to give 100% as loan, because some amount has to be there in the bank, so that whenever you and me go to withdraw money, there has to be some amount in the bank. For example, if you have deposited 100 rupees and the bank explains that it has an RDR, a reserve deposit ratio of 10%, it means that it will keep 10% of 100 rupees as reserve, while the rest 90 rupees will be given out as loans. So this is basically the ratio of how much reserve is kept compared to how much loans are given out. The third one is cash reserve ratio. Now this is a part of RDR. I told you there are 3 options while the bank has to keep reserves. One is to keep it in the vault, second one is to reserve it with the RBI, and the third part is to give it out as loans. So the second part is called as cash reserve ratio. So CRR is the part of deposits of a commercial bank which is supposed to be kept with the RBI. If a bank has 10 lakhs as deposits, the RBI could ask the bank to keep 1 lakh as reserve with the RBI, while the rest can be given out as loan. If the RBI feels that the loans are too much, it can simply increase the CRR so that lesser money is available with banks to give out as loans. And so this is how the RBI controls the loan giving process of a bank. Certain amount has to be kept as reserve with the RBI, and that is called as cash reserve ratio. Currently, as of December 2021, the cash reserve ratio in India is 4%, which means out of all the money that is deposited in a bank, 4% has to be submitted to the RBI by every single commercial bank as cash reserve ratio. This is safely kept with the Reserve Bank of India. The next ratio is statutory liquidity ratio. Once again, this is a part of RDR or reserve deposit ratio. Remember the three options: vaults with the RBI or as loans. This is the first option. It is the fraction of deposits which have to be maintained by every commercial bank as ready cash or liquidity in their vaults. With statutory liquidity ratio, the RBI can have additional control on the banks so that the money is always available for people on withdrawal, so that you and me can easily withdraw money and money is always available with the bank. I've given an example to understand what this means. If a bank has deposits worth 10 lakhs and has kept a CRR or cash reserve ratio of rupees 30,000 or 3% with the RBI can also force the bank to keep an additional 1 lakh as ready cash in the vault of the commercial bank. This makes only 8,70,000 available for loans. Remember, 10 lakh is the entire deposits of the people. In that, 30,000 is sent to RBI, which makes it 9,70,000, and 1 lakh is kept as ready cash in the bank's vault or locker. So this remains the amount of 8,70,000 rupees. Only this is available for loans to the people. Currently, the statutory liquidity ratio in India as in December 2021 is 18%, which means out of all the deposits received, 18% has to be kept as ready cash in the bank, in the vaults of the bank. And this is very easy to remember because the term itself, statutory liquidity ratio, explains entirely about itself. Statutory means according to law or as per statutes. Liquidity, which means cash. And so this means this is the compulsory amount of cash which has to be kept by the bank in its lockers so that you and me can have money whenever we want to withdraw. This is the fourth ratio. We will move into another ratio. This is called as bank rate. Commercial banks also have a facility of borrowing money from the Reserve Bank of India, which means whenever the commercial banks want more money, they can take loans from the RBI. And for that, they have to pay an interest rate to the RBI. And this interest rate is called as bank rate and also is called as repo rate. So currently the repo rate in India is 4%, which means whenever a commercial bank takes loans from the RBI, it has to pay an interest to the RBI, and that interest rate is 4%. Now, why does the commercial bank have to pay an interest? If the RBI increases the repo rate, banks will take less loans, and this will reduce the flow of money into the economy, because banks usually take loans from RBI and give them out for people as loans for a higher rate of interest so that they can earn more profit. So when the repo rate is increased, the commercial banks will take lesser loans because it is too costly, and with that the money flowing to the public will be reduced. If the repo rate is decreased, if the commercial banks have to pay lesser amount of interest, then naturally they will take more money because there is more chance of profit for the commercial bank, and with that the flow of money into the economy in the form of loans to the people will increase. So bank rate is also a very important ratio to be understood. The next one is reverse repo rate. So sometimes in order to reduce the flow of money, the RBI demands loans from commercial banks. This is in order to reduce the flow of money with the public. So RBI takes loans from commercial banks, and in return the RBI will pay an interest, and that interest rate is called as reverse repo rate. This is basically the opposite of point number 5. Currently in India, the reverse repo rate is 3.35%, which means whenever the RBI takes a loan from commercial banks to take out the excess money, that interest rate paid by the RBI is called as reverse repo rate, and it is 3.35%. How does it affect the economy? If the RBI increases the reverse repo rates, banks will be ready to give more loans to RBI because they want to earn more interest, and the flow of money into the economy will be reduced because from the people, the loans will be now diverted to the RBI. But if the reverse repo rate is decreased, then the banks will reduce. They won't like to give loans to the RBI. Instead, they will give at a higher rate of interest to people. and the flow of money into the economy will increase. So this is also how banks work. With that, we come to the end of this short video, where in the first video I explained about the importance of money, and in this video I explained about the basics of banking and the important ratios. In the next video, which is a continuation of banking, we will try to understand the complicated process of money multiplier. Thank you so much for staying tuned till now. If you found this video helpful, please do not forget to like, share and subscribe so that many more students can benefit from it. Thank you so much. Stay educated and stay safe.